Hello friends, how are you? I hope all of you are doing really good. So welcome to Economics of Finance Excellency batch. So in the last lecture, we have been discussing about the exchange rates, right? And I hope all of you must have studied, must have revised whatever we have done. So now we are very close to the completion of the batch, and I hope all of you must have enjoyed it. Okay, so we discussed about the regimes, the exchange rate regimes, the different types of quotes. Now, in this lecture, we are quickly going to see the different concepts, right? The concept of nominal and the real exchange rate, right? So, what is in this? We are going to study four concepts. One is the nominal exchange rate, another one is the real exchange rate. Then we are going to study the nominal effective exchange rate. Then we are going to study the real effective exchange rate, right? Okay, so now let's try to understand. We are going to study four things in this basically. One is the NER, that is the nominal exchange rate, then is the real exchange rate, then is the nominal effective exchange rate, and the real effective exchange rate. Just try to understand. Very simple, sir. Very simple. It is not that difficult. What is nominal exchange rate? He says when we say $1 is equal to rupees 75, right? This is the nominal exchange rate. That in the currency terms, what is how the currency of one country can be exchanged for the currency of another country. Here, if you want to exchange $1, you will have to give 75 rupees, right? So this is the nominal exchange rate. Now, what is the real exchange rate? Now, real exchange rate is, let's say my friend came from USA, he bought a pen for me. I asked him that how much is this pen for? He says $1. Now, what I did, mind in mind, I immediately converted this $1 into 75 rupees and I was shocked. I say 75 rupees for a pen. I can buy 10 pens in the 75 rupees, right? So when you try to find out in the output terms, in the goods form, that the good of in $1 and the number of goods exchangeable for 75 rupees, that is known as the real exchange rate. Let's try to read it these two. The nominal exchange rate determines how much of one currency can be exchanged for a unit of another currency under the constant prices. Real exchange rate determines the number of units of a good or service in one country that can be traded for one unit of the same good or service in a foreign country. So in the foreign country, one pen is for $1, right? In India, you can get the same for 10 pen. So this is how, this is your nominal, this is your real exchange rate basically. When you talk that in one unit of the currency, how many units of the goods can be bought in the foreign country, in our country, right? Now, what is nominal exchange rate? What is nominal exchange rate? Now we say that India is not trading only with the USA. Let's say India is trading with two different countries, right? Two different countries we are trading with. One is USA and another one is, let's say, England, right? Now, the exchange rate here is, the nominal exchange rate here is, we say $1 is equal to rupees 75, right? And for this we say 1 pound is equal to, let's say, rupees 80. Right now, this is what is known as the basket of currencies. When you have more than one currency in which you are dealing, it is known as the basket of currencies, right? Now, India says we are doing 60% of our business with USA and 40% of our business with the England, right? Now he says NER is the weighted average rate. Now, if you are dealing with the multiple currencies and you want to see that on an average, what is the rate of your currency in the world, how your currency is doing in the world, right? Whether it is at a very high rate or whether it is at a very low rate. So what you will do is they say how can you identify that how your current currency is doing in the whole world, not in the USA, in the whole world against a basket of currencies, right? So they say what you do is calculate. They say what you do is calculate weighted average rate. Weighted average rate. Now, weighted average rate based on how much of the business you are doing with that particular country, how much of the business you are doing with that particular country, right? So if you want to calculate here, what will be it? That is 75 multiplied by 60%, right? Multiplied by 60% plus how much? 80 into 40%, value divided by 75 plus 80, right? Clear? Now this will come to roughly 50 rupees rate, right? That means this is the average rate, average value of your currency in the world market, right? This is the average currency value in international market. Average currency value in international market, right? So what is this is NER, right? So what is RER? RER is nothing. He says it is NEER adjusted for inflation. When you consider the inflation factor also that is prevailing, that becomes the RER. Like we say that here it is 50 rupees. Now if you add the inflation, if there is inflation, you may say they add 5 rupees more, so it becomes 55. This is REER, right? So this is nominal exchange rate, the real effective exchange rate. The weights are determined by comparing the relative trade balance of a country's currency against each other within the index, right? Now, one line here is written that increase in RER implies that the exports become more expensive and the imports become cheaper. So an increase in RER indicates a loss in the trade competitiveness. Sir, how? If this becomes that, I will explain in the later section when we will study about the changes in the exchange rate, right? Then we will study about it, that what will be the impact on the exports and what will be the impact on the imports, right? So this can go the downward also. If there is no inflation, this can go downward also, sir, right? This can go downward also. RER, this one, right? The basic concept is when you are adjusting the NEER for the inflation, that is the main purpose here, right? So this was the concept of the nominal exchange rate, real exchange rate, nominal effective exchange rate, and the real effective exchange rate. You can just read it from here once and remember it, right? Then the next is the foreign exchange market. The foreign exchange market, what is the foreign exchange market? Where the trading of the currencies take place? Very simple, sir. It comprises of all the markets and institutions that handle the exchange rate of the foreign currencies, that where the trading of the currencies take place. Operates worldwide and the largest market in terms of the cash value involved. Obviously, sir, there are n number of currencies which are being traded in that particular market, right? No central trading location and no set hours of trading. There is no particular office for that. There is no particular location where you can go and exchange, right? But it is a phenomena, I can say. It is a worldwide market. You can find that office of this market, at the end of the road near your house, right? So there is no fixed location, but it is a market which is operating worldwide through small institutions, through small offices, through banks, right? So over the counter market and not a physical place. Over the counter means there are separate offices. You can go there, get the foreign currency exchanged. Simple. There is no one place, one market. No. Operates on the narrow spreads between the buying and the selling rates. The buying and selling rate. What is buying and selling rate? I told you in the last lecture that 72 to 74 buying and selling rate. Right. So there is a narrow margin between this. That this is known as the spread. The difference between the buying and selling rate is known as the spread. So they say this market operates on a very narrow spread, very small spread. Most transactions in the forex market involve the exchange of US dollars for the foreign currency. Hence, the dollar is often known as the vehicle currency, right? So in the dollar, in almost every country, the dollar can be used, dollar can be exchanged. That is why this is the most used currency in the world, right? Functioning, the participants use one currency to purchase another currency, exchange of currencies. The market encompasses electronically linked network of being banks, dealers, and foreign exchange brokers who bring the forex buyers and sellers together. Right, so it is a market where the forex buyers and sellers can come together. It is everything is electronically linked. The exchange rate is decided electronically through the worldwide network, right? Then although the margin per transaction is very narrow, there is a possibility of making huge profits because the volume is high, because the volume traded are very large. The margins may be narrow, right, but the volume being very high, they can make the huge profits, right? So who are the participants? The central bank is the participant to contain the exchange rate volatility. So central bank participates in it not to earn the profits, right? But central bank is involved to avoid any exchange rate volatility, as we discussed in the regimes, right? They do not trade with the motive of earning the profits. Commercial banks participate either on their own account as the speculators or the arbitrators, or the participate for their clients. The main goal is to earn the profits. Now, commercial banks can enter into the foreign exchange market. They can buy and sell the foreign exchange market on the behalf of their clients also, or on their own behalf of also, with the aim of earning the profits, right? The foreign exchange brokers are there. The brokers have the same goal, right? They participate as the intermediaries between the different foreign exchange dealers or the bankers. Arbitrators, we will study about it, participate with the sole motive of making the profit by discovering the price differences between the pairs of currencies with the different dealers or the banks. How the arbitrage process goes on, I'll just explain you after this. Speculation, you keep on speculating that today the currency rate will be this or this or this. You are taking the risk deliberately to earn the profits from the unexpected changes in the exchange rate. Speculation, right? Government to sell the purchase forex with the same aim as that of central bank. That is, even the aim of the government is not to earn the profit, sir. It is to contain the volatility, right? So all these people can participate in the foreign exchange market, some with the motive of earning the profit, some not with the motive of earning the profits, but to contain the exchange rate volatility. The central bank and the government, these two agencies are not involved in the foreign exchange market for earning the profit. They are involved for containing the volatility. Clear? After that, it's the arbitrage. What is arbitrage, sir? What is arbitrage? Let's try to understand the arbitrage. Okay. So simple process, sir. Very simple process. When you are dealing in the multiple currencies with the motive of earning the profits, right? Let's say today $1 is equal to rupees 70 rupees, right? Now you go to the bank, you ask the bank, you pay 70 rupees to the bank and you say, give me $1. Now the bank will give you. Any doubts, right? The rate is $1 is equal to 70 rupees. You go to the bank, please give me $1. The bank will say, give me 70 rupees. You pay the bank 70 rupees. Fine, sir. You get $1. Now, you take this dollar, you go to another bank, you will say, bank, I need £1. Okay, the dollar will say, let's say £1 is equal to $1. The bank will say, okay, give me the dollar. Give me $1, I'll give you £1. You give the dollar to the bank and get £1, right? Now, you go to another bank. You say, bank, I have £1, I need rupee. The bank says, okay, £1, the rate is rupees 80. You said, okay, no issues. You give £1 to the bank and get rupees 80. Now, what was the initial amount that you paid? Rupees 70. Now, what is the amount that you are getting by selling the pound? That is rupees 80. That means you have gained 10 rupees here. This is the arbitrage process. When you buy and sell the multiple currencies with the aim of earning the profit, this 10 rupees is what? This is your profit. This is known as arbitrage process, that you buy one currency, you sell another currency, you see the opportunity, okay, the rate is higher, sell it and earn the profit out of it. This is the arbitrage process, right? So it refers to the practice of making the riskless profit by exploiting the differences in the price of asset at the different location, right? So due to the differences in the price of dollar and the pound, you took the advantage of that situation, that let's do it, let's earn the arbitrage profit out of it. So arbitrage occurs in the forex market when the exchange rate between the currencies are not consistent in the two different markets, right? The same thing you can, what does he saying, that let's say there are two markets, or let's say you are in Delhi and one you go to Mumbai, right? In Delhi you say I want $1. You go to bank, the bank says the dollar is for 70 rupees, give me 70 rupees. Let's say not Delhi and Mumbai, because in India it will be same. Let's say you are in India, right? And you want to go to, let's say, Africa. Clear? Or any other part, sir. $1 is equal to 70 rupees. The same way, now you go to Africa, you pay 70 rupees, you get $1. Right? Now, here the exchange rate might be different. Now, let's say in Africa also they are using the rupee. Let's say, example, sir. Right? You go to Africa, there the rate is $1 is equal to rupees 80. Now, what will happen, sir? You paid 70, you get 80, again a profit of 10 rupees. So this is what is known as arbitrage gain, right? This is the arbitrage process that is going on. Clear? Now you can read it from here. I have explained you that what is the arbitrage process. After that, the types of transactions. Two types of transaction take place. That is the current transaction, that is the spot rate, carried out in the spot market. Right now there will be exchange of the currencies. Right now, whatever the rate is prevalent, we will exchange the currencies right now, right? Delivery might be after 1 or 2 days. For example, you want to buy something from the Amazon, you pay today, you might get the delivery after 2 days or 3 days, right? But what you are doing is you are doing the transaction today. The same thing is happening in the foreign exchange market, that you will do the transaction today and right now at the spot rate, whatever the exchange rate is prevalent right now. At the time of transaction, you will do the transaction. The delivery of the currency might be after 2 days. So the exchange involves the immediate delivery, usually 2 plus 2 period, that is the transaction day plus 2 days. The exchange rate for the spot trading are called the spot exchange rate, right? After that, it is a forward transaction. The forward transaction is that you want to buy or sell the currency at a later date, So forward contracts are contract to buy and sell the currency for future delivery. These transactions are carried out in the forward or the futures market. The actual delivery of currency takes place at the specified future date. The exchange rates are called the forward exchange rate. Now the exchange rate at that time, what will be the exchange rate? It can be fixed, right? So currency future is, although they are similar to currency forward, they are distinct in their nature, not really relevant, right? Forward discount, when the spot rate is more than the forward rate. Today, if you transact, $1 is rupees 75 and the forward rate may be something else. The forward rate may be that $1 is equal to rupees 72 or 78. It can be anything, right? It can be, the spot rate can be more or the spot rate can be less than the forward rate. When it is more than the forward rate, we call it as the forward discount, that the forward rate is at a less price, at a discounted price. Whereas if the forward rate is more than the spot rate, forward rate is the future date when the transaction has to take place, right? And what is the forward premium? That means the forward rate is more than the spot rate, right? So this was the two types of transactions in this. Now, determination of nominal exchange rate. He says the equilibrium exchange rate is determined by the interaction of supply and the demand of foreign currency in the domestic market. That what is the supply of foreign currency and what is the demand of the foreign currency. He says, why do we demand foreign currency, or why there is a need for the supply of forex currency? Simple, sir. When you will demand the foreign currency, when you will import the goods and services, you are importing, you need to pay the the exporting country in the dollars. Let's say you buy goods from USA. You buy goods from USA, right? Now, from the person whom you have purchased the goods, can you pay him in INR? No, sir. You will have to pay this person in the US dollar. That means you will first buy US dollars from the market, right? Against the INR, you will buy the US dollar and then pay to this person, right? So for the imports, you need this forex. Suppliers, for the exports, you need the forex. You will get the forex and you will exchange the forex. That is the supply, right? So basically, when you have to pay someone, right, in the foreign currency, you will demand the foreign currency. And when you will get the foreign currency, there will be a supply of foreign currency because you will sell that foreign currency in the Indian market and get the Indian rupee. That will be the supply. So he says equilibrium will be when the demand will be equal to supply. Just read this. Just read this. Everything is given here, right? So when the demand and supply curve, they meet each other, there we determine, right, the nominal exchange rate or the equilibrium exchange rate. Now this is the quantity. Now the demand will keep, if the demand keeps on increasing, right, similarly the supply curve is upward sloping and demand curve is downward sloping. The more the supply, less will be the demand, right? Downward sloping demand curve and the upward sloping supply curve. Why? Because if the supply keeps on increasing, the demand will be limited to a certain level. The demand will start falling, right? So you can just read it. Now changes in the exchange rate, just try to understand now, because you will be reading the further part. I'll not be covering, right? Because this is very simple, sir. You just, for the whole of this part, what you need to understand is the basic, that how the change in the exchange rates, they affect your economy, right? The appreciation and the depreciation. Just try to understand now the changes in the exchange rate. We'll talk about changes in exchange rate because the further topics are based on this only, right? If you are able to understand this, you just have to read it. That's it. You will be able to understand. You just have to read it. Simple. For the remembering purposes from the examination point of view, anyhow, have to read it 3 to 4 times, right? So changes in the exchange rate, if you talk about the changes, there can be two types of changes. One is the appreciation. One is the appreciation of, let's say, we'll talk about in terms of home currency, right? Home currency. Then we have the depreciation. The second is depreciation of home currency. Right? Now, let's say at a particular point of time, the rate is $1 is equal to 70 rupees. Now, what is the home currency here? The home currency is INR, that is 70 rupees. Now, what is depreciation of the home currency? So, depreciation of the home currency means that there will be a change in this rate. The first thing, there will be a change in this rate. Now, what will be the change in this particular rate? Now, if this rate changes to, how we define depreciation, if this rate changes to $1 is equal to rupees 75. Now, what will happen, sir? Here, now if you want to buy $1, earlier you were to pay 70 rupees, but now you will have to pay 75 rupees for $1. That means here the home currency has depreciated and the foreign currency has appreciated, right? Because the value of the dollar has increased. Earlier it was 70 rupees, now it is 75 rupees. And in terms of home currency, if you see, earlier if you want to buy $1, you will have to pay 70 rupees, but now you will have to pay more money to get $1. That means the home currency has depreciated. Sir, what about appreciation? The appreciation is the reverse. $1 is equal to rupees 65. Here, the home currency has appreciated. Earlier, you were to pay 70 rupees to buy $1. Now, you can get it in lesser money. That is in 65 rupees only you will get $1, sir. So, that means the home currency, the value of the home currency has appreciated. Right? Now, what is the impact of this appreciation and the depreciation, sir? What is the impact on exports and imports? Try to understand. Sir, what will happen with the exports? What will happen with the exports and what will happen with the imports? If you talk about exports, Sir, in case of exports, what you will get? You will get $1. You will get $1. Right? From the foreign market, you sell the goods to USA and you are getting $1. Now, what will you do? You will take this $1, go to the forex market and say, give me rupee. Right? How much rupee you will get? 75. Earlier, if at this particular rate, let's say you are doing the export, how much you would have got for $1? You would have received 70 rupees. What is the value that you are receiving after the home currency depreciation? You are receiving 75 rupees. That means this is beneficial for the exports. The home currency depreciation is beneficial for the exports because you will be getting the higher value. Right? It is beneficial. Now, what about imports? Let's say you import goods worth $1. Right? You import the goods worth rupees $1. It's not rupees, sir, $1. Okay. Now, what will you have to do here? You will have to buy dollar from the market. Buy dollar from market to pay for imports, right? To pay for imports. Now, if the rate is $1 to 75 rupees, how many rupees you will have to give to the dealer to get $1? Now you have to pay that exporting country in the dollars, right? You need the dollar. You went to the market, you went to the bank. You says, bank, please give me $1. I need to pay for my imports. The bank will ask you, pay 75 rupees, right? Here you will pay rupees 75. Here you are getting 75 rupees. Here you get 75 rupees. Here you pay 75 rupees. Earlier, you would have paid, in case of import, what is the amount that you will have paid? You would have paid rupees 70. Now you are paying 75 rupees. You have to pay more, right? So in case of depreciation, the imports, this is not beneficial for imports. Clear, sir? The reverse is the situation in case of the appreciation of home currency. Sir, in case of appreciation of home currency, what will be the impact on the exports and imports? What will be the impacts on imports and exports? Just try to understand. Sir, in case of exports, now the $1 is 65 rupees. Now you get $1. You go to the market, you go to the bank, I have $1 in my pocket, please exchange it and give me rupee. The bank says, okay, I'll give you 65 rupees. Earlier, the bank would have paid 70 rupees. Now the bank will be paying you 65 rupees only. Is it good? No, sir, it is not good. For the imports, it is beneficial. Why, sir? You want to buy $1 here. You want to buy $1. How much of the money you will need to pay? Pay 65 rupees. Earlier you would have paid 70 rupees. Now you will pay 65 rupees. Beneficial, sir. It is beneficial in case of imports, right? Not beneficial. And here it is beneficial. Any doubts in this thing? So this is how the changes in the exchange rate take place, and this is how the changes in the exchange rate impact your exports and the imports, right? Okay, so this is all what is given here. Home currency depreciation. When will the currency depreciate? Sir, the currency will depreciate when the demand is more than supply. When demand is more than supply, the currency will depreciate. Obviously, sir, when the demand is more than supply of the US dollar, when the demand of the US dollar is more than the supply, what will happen, sir? US dollar will appreciate, right? Sir, simple. If you want to buy some good, let's say you want to buy a car, the demand for the car is more than the supply. Now, what will the car dealer do? He will increase the prices because he knows that there is huge demand. If the car is worth 8 lakh rupees, even if he is going to ask 12 lakh rupees, people are ready to pay for it. Why? There is a demand, right? Demand for what? Demand for US dollar or the foreign currency. In that case, this foreign currency will appreciate. And home currency will depreciate, and home currency will depreciate, right? The reverse is the situation in case of appreciation. In case of appreciation, what is there? The supply is more than the demand. Supply of what? Foreign currency or the home currency? Sir, foreign currency. Sir, supply, there is abundant supply, but there is less demand, right? So in that case, what will happen, sir? This US dollar will depreciate, and the home currency will appreciate, right? So this is what you have to study, right? Just read it from here. The impact of exchange rate movements on the international trade flows. This you can just study. Depreciation versus devaluation. Now this is important topic. Sir, the basic impact is the same, that depreciation or the devaluation. Devaluation also means that you are depreciating the home currency, but the difference between the two is, in case of depreciation, it is automatic based on the demand and supply in the market, whereas in case of devaluation, it is deliberately done by the central bank or the government of a country. It is deliberately done. The currency is devalued. Why? To encourage the exports, to increase the exports, value of exports. That is why the devaluation is done, right? So devaluation is a deliberate downward adjustment in the value of a country's currency relative to another currency or a group of currencies, right? Devaluation is caused by the action of the government or the central bank monetary authority policy actions applicable for a relatively fixed exchange rate regime, right? So you can, if you are going to deliberately change it, or the intervention of the central bank or the government is there, so that means there is mostly a fixed exchange rate, right? Whereas devaluation in case of floating, because it is being determined by the demand and supply, and we studied about that in case of floating exchange rate, it is being determined by demand and supply, whereas if you have a fixed exchange rate, there is the intervention of the central government or central government or the central bank also, right? It is a monetary policy tool to make the official reduction in the par value of the currency and boost the exports basically, right? So the next topic, the impact of exchange rate fluctuations on the domestic economy, right? How it can impact the economy, just go through all the points. And the other impact of currency depreciation, just read it. Other impact of currency appreciation. What are the impacts of currency? But broadly, what you have to keep in mind is, this particular chart. And when you will read all the impacts, keep this thing in mind, that how it is going to impact the domestic economy and how it is going to impact the foreign economy, appreciation also and the depreciation also. Read all the points keeping this chart in mind. You will be able to understand easily, right? So read it from the books. You will be able to understand. In case you find any difficulty, all of you who are having our handbooks, they can WhatsApp us, because you have got the WhatsApp support, right? And others can email us at ksjteaching@gmail.com, right? So with this, the exchange rate is done. It was a very simple topic, sir. Very simple topic. Now we are left with just last chapter, that is international capital movements. Very simple chapter again. Very simple chapter. We'll try to complete it in 1 or 2 lectures, because this is very simple. This is not very difficult. FDI, FPI, interesting but simple, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.